Audit sampling is a fundamental auditing technique that enables auditors to obtain sufficient appropriate audit evidence without examining every transaction or account balance within a population. ISA 530 audit sampling defines audit sampling as the application of audit procedures to less than 100% of items within a relevant population in such a way that each sampling unit has an opportunity for selection, allowing the auditor to draw conclusions about the entire population. Because modern organizations process vast numbers of transactions, complete examination is generally impractical, costly, and inefficient. Consequently, auditors apply sampling techniques to achieve a balance between audit effectiveness and efficiency while maintaining an acceptably low level of audit risk. Proper sampling techniques support the auditor's objective of obtaining reasonable assurance that the financial statements are free from material misstatement arising from fraud or error. The need for audit sampling arises from both practical and professional considerations. Testing every transaction would require excessive time and resources while providing limited additional assurance in many circumstances. Instead, auditors select representative items from the population to obtain evidence regarding the operation of internal controls or the accuracy of financial statement assertions. Sampling allows audit effort to be concentrated on areas of greatest risk while maintaining cost efficiency and timely completion of the audit engagement. The effectiveness of sampling depends upon the representativeness of the selected items, the size and characteristics of the population, the assessed level of audit risk, materiality, and the auditor's professional judgment in designing appropriate sampling procedures. Audit sampling may be classified as statistical sampling or non-statistical sampling, depending on the selection methodology employed. Statistical sampling uses probability theory and mathematical techniques to select sample items and evaluate sample results. Every item within the population has a known probability of selection, allowing auditors to quantify sampling risk and project sample findings objectively to the entire population. Statistical methods include random selection, systematic selection, monetary unit sampling, and probability proportional to size sampling. These approaches enhance objectivity, facilitate scientific evaluation of results, and provide measurable confidence levels regarding audit conclusions. Statistical sampling is particularly valuable where populations are large, homogeneous, and capable of quantitative analysis. In contrast, non-statistical sampling, often referred to as judgmental sampling, relies primarily on the auditor's professional judgment rather than mathematical probability. Sample selection may be based upon risk assessment, materiality, unusual transactions, high-value balances, or specific characteristics considered significant by the auditor. While non-statistical sampling is often simpler and less costly to implement, it does not permit statistical measurement of sampling risk or objective projection of errors to the entire population. Consequently, conclusions depend heavily upon the auditor's experience and professional judgment. Despite these limitations, judgmental sampling remains widely used in practice because it provides flexibility and enables auditors to target areas of greatest audit significance efficiently. Several basic principles of statistical sampling support effective audit testing. The population from which samples are selected should be complete, appropriate to the audit objective, and sufficiently homogeneous to permit meaningful conclusions. Sample size should reflect audit risk, materiality, expected error rates, and the desired level of assurance. Larger sample sizes generally reduce sampling risk and increase confidence in audit conclusions, particularly where control risk or inherent risk is high. Sample selection should avoid bias by ensuring that each sampling unit has an equal opportunity for selection under random methods. Following testing, identified errors should be evaluated and projected to the population where appropriate to determine whether the population may contain material misstatements requiring further audit action. Auditors also employ other selective testing procedures in addition to statistical sampling. One common method is random selection, where every item has an equal chance of selection using computer-generated random numbers or statistical tables. Systematic selection involves choosing items at regular intervals after a random starting point, such as every 50th invoice within a population. Haphazard selection allows auditors to select items without conscious bias but without structured randomness, relying on professional judgment to avoid predictable patterns. Block selection, which involves selecting consecutive groups of transactions, is generally less representative because transactions occurring together may share similar characteristics and therefore may not reflect the entire population accurately. Auditors may also apply targeted selection, focusing on high-value, unusual, or high-risk items where the probability of material misstatement is greatest. These selective testing methods complement statistical sampling by enabling auditors to address specific audit objectives efficiently. Practical applications of sampling occur throughout the audit process. Tests of controls may involve selecting a sample of purchase orders to verify evidence of management authorization or examining payroll records to confirm supervisory approval of overtime payments. Substantive testing may include sampling customer invoices to verify revenue recognition, selecting inventory items for physical inspection, or confirming a sample of trade receivable balances directly with customers. Monetary unit sampling is frequently applied when testing receivables or inventory because larger monetary balances possess a greater probability of selection, thereby improving audit efficiency in areas of material financial significance. Selection methods should always align with the audit objective and the characteristics of the population being tested. Evaluation of sampling results requires careful professional judgment. Auditors assess the nature and frequency of identified deviations or misstatements and determine whether they indicate isolated errors or more pervasive problems affecting the population as a whole. In statistical sampling, identified errors may be projected mathematically to estimate likely population misstatement and compared with tolerable misstatement or tolerable deviation rates established during planning. If projected errors exceed acceptable thresholds, auditors may conclude that internal controls cannot be relied upon or that account balances may be materially misstated. Such conclusions require modification of the audit strategy, including expanded substantive procedures, increased sample sizes, or additional testing directed toward high-risk areas. Additional testing becomes necessary whenever sample results fail to provide sufficient assurance regarding the population under examination. Unexpected deviations, high projected error rates, significant control failures, or evidence of fraud may require auditors to increase sample sizes, perform alternative audit procedures, or extend testing to additional populations. In extreme circumstances, widespread deficiencies may require complete testing of particular transactions or balances where sampling no longer provides adequate assurance. By applying appropriate sampling techniques and critically evaluating sampling results, auditors obtain reliable evidence efficiently while maintaining audit quality, reducing sampling risk, and supporting well-founded audit opinions consistent with international standards on auditing.